Good morning, everyone, and thank you very much for joining me. This is the morning market review, and it is Wednesday. It's the 4th of October. My name is Russell Shaw. I'm a senior market specialist at FXCM, and my email address is rshaw@fxcm.com. If you'd like to correspond, that's the email address to use. I'm going to go ahead and bring up our disclaimers. We'll start off with the high risk investment warning. I'll keep this on screen for a few moments. Good morning, Kim and James, Sai, Mateus. Good morning to you all. Thank you very much for joining. It is highly appreciated. Hey, Raj, good morning to you. On Friday, there's going to be a live trade for the non-farm payrolls, and I'd like to invite you all to attend. If you'd like to attend, I'm just putting the registration link in the chat. Just go ahead and click on that, and you're certainly most welcome to attend. So that's in the chat. I'm going to bring up the market commentaries disclaimer. All right, now the references MarketScope 2.0 and TradingView.com. I'm finding this market, it's a challenging market. There is no doubt about that. What we shall do is go through to the real rate, and what we'll consult with the real rate here. What I want to show you guys is just some trend line analysis here. First of all, before we get to the trend line, we are overbought. Okay, we've been looking at this since Monday. Despite the fact that we are frothy, the yields continue to rise. That's making things difficult, because as long as yields continue to rise, dollar is going to be supported. Risk markets are going to be under pressure. Yesterday we saw a data point called the jobs openings, JOLTS data. Job openings came in higher than expected. Well, that suggests a stronger than expected economy. That's going to lift rates, and what we're seeing is these rates here are being extremely resilient, and these resilient rates are driving the market. Where the difficulty comes in is, well, wait, it's overbought. How much higher can these rates go for this leg? I'm of the opinion there's still going to be a pullback here. What we can do is we can put in trend lines. So you can put in a trend line as such. Okay, I'm going to make that green. Then the gradient of the trend line increases. Okay, I'm going to make this one orange. So it's like your traffic lights. And then let's just take out the EMAs, I think it'll be easier. And then I'm putting in a third one. And this one is red. So the gradient here is increasing. Now, what trend lines do, they don't determine trend. What trend lines do is they measure the speed of trend, okay? And eventually, when you get to a gradient, which is steep, and usually it's the third trend line, usually it's the red trend line, that's registering a market as overbought. So if you think about it in terms of rate of change, you can see the yield is increasing at an exceptional pace. So it's basically your y-axis, the yield increasing, compared to the time axis, the x-axis. And it's really, this is a short period at pace, a high yield over a short period. It's looking extremely frothy, but it's complex. Why is it complex? Because it's not breaking down, okay? And the question is, how much higher can it go before it breaks down? And that is really making life difficult for us. I want to show you another chart. Okay, I want to show you the IEF. Okay, so just to be clear, okay, what we're looking at here is the yield of the bond. IEF is an exchange traded fund which looks at the price of bonds, and prices tend to move opposite to yields. As yields push down, prices would push up, and as yields push up, prices would tend to push down. Well, yields are pushing up at the moment, and the fact that yields are pushing up at the moment, well, we're seeing this movement down, this real push down in bond prices. Now, again, what I want to point out here is a Dow theory cycle. The Dow theory cycle was really actually applied to the stock index, but I think the cycle in of itself is applicable to many instruments. And we have here is that the price of bonds also tending towards oversold, and the cycle moves as follows. Let me show you this. It comes from Dow theory, and for a bull market, you typically have three phases of a bull market. So you'd have something called renewed confidence, you'd have improved earnings, and then you have rampant speculation. I'm just going to type those in. Okay. First, renewed confidence. It's usually a fairly quiet period. Then you have improved earnings, which is probably the longest stage and the most stable stage. And then you have the extreme volatile stage, with the most dangerous stage, but where the most gains are made, rampant speculation. Okay, and that tends to be your bull market. Okay, the bear market goes like this. Something like that. So the first stage of the bear market is what we call abandonment of hopes. Abandonment of hope. The second stage of the bear market is poorer earnings. And then the last and the most devastating of the bear markets is panic selling. But after the panic selling stage starts, we go back into sort of a renewed confidence. And I just wonder if we go back to our bond prices, the bond market's been absolutely hammered. If you are holding a bond, the price is being obliterated, and you can see it's just moving in that southeast, and that's why we're getting these higher yields, with the idea that the yields are going to be higher for longer. I wonder if that's just some sort of emotive phrase that we're dealing with at the moment. And the question I pose to you is this over here. Is this rampant selling? Okay, so is that what we're seeing in the, let me just correct the spelling there. Is this what we're seeing in the bond market? Are we seeing the last stage of the bear market? In other words, are buyers going to come in because the value's there? The real bond market participants that are in the know. At the moment, we don't see any signs of support. We don't see any signs, but I think we must be getting to the bottom of this type cycle. If we get into this bottom of the cycle, it makes sense that we're seeing the real yield overbought as well. Okay, seeing that real yield overbought. Now, what I'm suggesting here is at the moment all very speculative, isn't it? What we need is a timing mechanism to tell us when the bond market has stabilized. And that's where we can use our exponential moving averages. So what we can do is we can put the EMAs in and wait for some sort of positive plus. I won't put that in right now. But at the moment, we could be, I think, at the last leg of the bear market in the bond market. Guess what? That's the toughest. It's when guys don't want anything to do with bonds anymore. They've just been absolutely hammered left, right, and center. But that's when the value's there. That's when the pros go in and pick up some real bargains. And if they're picking up the real bargains and they push prices slowly up, yields perhaps start coming down. Again, all very speculative, but I want to pose the question: are we in this rampant, in this panic selling that we're seeing down in the bond market? So if we go back to the real yield, let's go just to show everybody the ticker. It's US 10-year, and then just put in what's called the break even. If you guys have ever heard of the TIPS, Treasury inflation protected securities, that's what we're looking at. That's what the real rate is. It's the TIPS yield, and you can see that we have got this we've just got this absolute froth that has manifested on yields, and we're getting some talk out of the media, which is really scary stuff. Higher for longer, rates are pressuring financial markets, etc. I think within all of that, if we had to sort of work our way through all the sort of fog, I think there are opportunities that are starting to set themselves up for us. It's all about us being patient. Patience now is our biggest asset. Okay, so the idea here is we want to be very, very cognizant of just the market cycle. Just taking a look at a few comments here. What does the monthly show? Are you looking monthly on IEF, KD? So the monthly here would show an overbought market in terms of real yield. In terms of IEF, let's take a look. Tending towards that oversold. You can see this is really getting hammered. What we can do, let's just change this to logarithmic. Yeah, and I pose the question again: are we in that panic selling? I suggest we probably are. Are we anywhere near the historical support in the bond market? Yeah, absolutely. you go back all the way to 09, okay, there's your support level. Okay, so yeah, we kind of at that level, Raj. And again, it's all very much a hypothesis now, but it's really what we've got to look at. If we see, let's just go now through to market scope. If we see the bonds starting to come down, okay, I suspect we start seeing this move back as well, the US dollar. And if the US dollar starts moving down, I suspect we see some support in the euro and the pound. Can I guarantee that's the move that's going to take place? No, absolutely not. We've got to follow the market. We've got to follow the market. But we specifically put the RSI in to warn us of excess froth. And when we have that excess froth, there is a skew in the risk reward profile against us. The risk is heavier for us. The whole game of trading is managing risk. I urge at the moment, patience is absolute necessary. We've got these half froth markets. It's making things very, very difficult for us. At the same time, if we take a look at, I'm just going to bring up NASDAQ here. The NASDAQ does look fragile at the moment. We've got this lower peak, lower trough. I want to monitor this with the 30-week exponential moving average and see if that 30-week exponential moving average holds. And if it does, can we get back above the trend line? Can we get back above 50? That in of itself would suggest to me that perhaps the market cycles are tending to work through. So I guess the whole idea behind this discussion this morning is that patience really is our biggest asset. We are in half froth markets. There is a lot of talk on the media. There's a lot of talk with pundits. I think it's throwing a lot of confusion out there. I just want to see the markets normalize. Once they normalize, we can make better, more informed decisions. All right. That's as far as we're going to go this morning, because I am going to go through to the Crypto Minute. That's our next webinar. We just do 2 webinars on a Wednesday. Please share the bond prices screen. So there's a couple of bond price screens, James. I'm just going to show you the IEF. The IEF. Okay. All right. IEF. Does it help, James? All right, guys. Thank you very much for joining me this morning. Please join me for the Crypto Minute and have a great day ahead. And we shall look at this again tomorrow. Try to work our way through these cycles. Thanks very much, and speak to you tomorrow.